Hello again, I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management. So thanks for being here with us this morning for this webinar session. So after a year characterized by extreme price volatility, energy markets starts 2022 with major remaining uncertainties on the supply and demand outlook, especially in Europe. So today, our experts will try to bring you more clarity on the risk factors and the main drivers expected to influence energy markets in 2022. So we'll start, as usual, with Olivier Gasnier for macroeconomics topics. It will be followed by Loïc Balland for an outlook on the oil market. Then Évariste will take care of the natural gas and energy markets, and Etienne Covin will close the session on EUA and power markets. So let me remind you that this is an interactive session, so don't hesitate to use the chat module to ask questions to our speakers. We'll do a Q&A session after each presentation, and you will also be asked to fill a 30-second satisfaction survey at the end of the session. The slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform. Before we start, I would like to talk a few seconds about the energy risk commodity rankings, which is the biggest survey in the commodity trading industry and a key recognition of the quality of the services provided by ENGIE. So votes are opened until the 25th of January, and you'll find the link towards the survey in the chat module. So it would be really great if you could take a few minutes to fill it. Thank you. And so before we start the session, I will just ask you to fill a very short survey with one question about your expectations on energy prices. So when do you expect European gas and power prices to drop from the current highs? I will let you a few seconds to answer. So do you expect prices to drop really shortly in the coming weeks and months, or do you expect a downward move later in the year, or even next year, or not before 2024? It would be really interesting to see the trend, and also to see if our experts will confirm this forecast in their presentation. So I will close the vote in 5 seconds. All right. So thanks for those who took the time to answer. And we see that the results are relatively split, with a majority expecting a drop this year before the end of the year, and but also we see the biggest group in 2023. So thank you for this, and we'll see if our experts will confirm this. So let's go back to the presentation with the macroeconomic outlook. So Olivier, the floor is yours.
Thank you, Julien. Hello, everyone. Best wishes, and thank you for attending this webinar again. So when we launched this invitation, we were probably, the topic for macroeconomic was Omicron versus inflation. I would say we were more Omicron than inflation, if I may say, that were just after the holiday season, marked by incredible surge in new COVID cases and a comeback to restrictions we thought having left behind last spring. 2 weeks later, I think we see light at the end of the tunnel, but I fear that the light could be that of the train of inflation, which arrives at full speed, and we will talk about that with a few slides. So let's start briefly with Omicron. Thanks to the vaccination, it's absolutely obvious that the economic effects of the waves of COVID have decreased significantly since the spring of 2020, as you can see on the graphs describing the evolution of the ISM indices in the US and the confidence indices in Europe. The threat of the Omicron wave is quite different, related to its contagiousness rather than its dangerousness, I would say. But the trend remains the same, and that is to say we have probably a lower economic impact again compared to the previous waves. And as I just told you, confidence survey seems to confirm a moderate slowdown in activity. On that, probably mainly in services and retail trade, while the industry seems rather spared. Although we could say that Omicron is likely to lengthen the supply issues the industry has been facing since the start of the pandemic. Weaker impact does not mean no impact in terms of a slowdown in activity. And for example, we have seen a sharp contraction in US retail sales in December. And we have a lot of high frequency data, but few indicators describing what happens on a monthly basis so far since the start of this new wave, new Omicron wave. January is probably going to be worse, whether in the US or in Europe. For example, yesterday we had a sharp fall in the New York Empire Manufacturing Index. That was actually the second biggest fall on record. So that seems to point to a month of January that won't be good again. But what is probably important is that the worst seems already over in terms of this Omicron wave, and a strong activity rebound should follow rather quickly. So that all in all, there would be no contraction in GDP either in Q4 2021 or Q1 2022. It's also likely that the surge in inflation has started to limit consumption, to have a negative impact on consumption by restricting household purchasing power. You can see on the graph on the right on this slide the sharp deterioration in terms of inflation expectations when you look at US consumer confidence surveys, whether they come from the Conference Board and the University of Michigan. And that's a good transition towards the inflation part of this presentation. If you want to look at our economic forecast, I will not insist on that. You have all this in the monthly report that has been released yesterday. So inflation, very simple graph to start with. They describe the rise in inflation that has kept on increasing until the end of 2021. So some figures: 7% in the US, 5.4% in the UK. That's not on this graph, but we had the figures this morning. 5% in the euro area. So that, for example, for the euro area, that's almost 1 point above the previous record high level of 2008, when the oil price reached around $150 per barrel. The UK inflation is expected to go much higher, and probably to near 7% by April. This is the same trend for core inflation, with the exception of Japan, but you can see that there are differences. And in particular, structural factors appear much stronger in the US and the UK than in the euro area, and so the prospect for a rapid return to moderate inflation appear much weaker in the US or in the UK than in the euro area, and that's of course has implication for the prospects of monetary policy. So I will tend to focus on the US situation, because it's really where we have the main issue in terms of inflation. On your left, on the left, the left graph, you can see many measures of US core inflation. Many alternative measures of inflation to isolate the impact of COVID, of the rise in energy prices, etc., have been built to demonstrate that inflation was temporary. That worked, I would say, in the first part of last year, but very quickly the central banks were very long to admit that, but it was obvious that these measures of core inflation were sharply on the rise, and that it was not a temporary phenomenon. The main reason behind this was energy, first, with a basis effect on energy prices, plus the rise in energy prices last year. And you had also all these issues linked to distribution chain or production chain at the global level, so supply issues to sum up. But both effects were worldwide, not specific to the US. More specifically to the US, you had the situation in the job market, with a sharp rise in unemployment first in spring 2021, and nearly 2 years after, you have still more than 2 million jobs missing on the US job market, with very unusual developments now, with, for example, wages of low-paid jobs posting the highest increases. We can clearly see that the power has shifted from companies towards employees. The job market is very, very tight in the US. The unemployment rate has fallen below 4%. Of people quitting voluntarily their job, as you can see on the graph, have never been so numerous, and the wages continue to accelerate. That is on the upper hand graph on the right. You can see the comparison between the evolution of wages in 2021 and the same evolution during the pre-crisis period between 2015 and 2019. There is an obvious acceleration. The second reason specific to the US was the recovery plans. With third recovery plans implemented between the end of the Trump era and the start of the Biden presidency, and that has absolutely boosted the purchasing power of US consumer at a time when supply was constrained. So, what scenario for the US inflation? What I have done on this graph is that I have, put several scenarios. The maximum scenarios, which is no change compared to the situation in 2021. So that means you have exactly the same kind of pressure, upward pressure on prices you have last year. The lower scenario describes a situation where you have a total comeback to the 2015, 2019 situation with the same average monthly increases, and in that case, that would bring back the inflation towards 2% at the end of this year, as you can see. And between that, you have other scenarios. So knowing that the situation in 2021 was more or less a situation where you had increases in prices 4 times faster than in the 2015-2019 period. So you have alternative scenarios where we take the average evolution of prices in the pre-crisis period multiplied by 2 or by 3. What we can see on this graph is that the consensus, this is the very last consensus on Bloomberg, and this is really the January survey, so it's very recent. It takes all the available information. The consensus is, in my view, again, too low, as it was the case at the start of last year. It sticks to a scenario where you have a complete comeback to the situation that prevailed before the crisis. So of course that is very interesting, because it means that probably the evolution of inflation is underestimated again, and of course, as a consequence, the evolution of the rates of the central bank rates, the Fed rates, is also underestimated. This is the last slide, just to underline the fact that probably we enter a new era where this is the end of easy money. First, you have the policy of the Fed. The Fed is reducing its asset purchases very quickly, 30 billion a month, so that the program will cease in March, and that will open the door to a rise in the Fed fund rate as early at the March meeting. It's absolutely clear that now most of the Fed members are ready to do so. On the market, as you can see on the graph, is now anticipating 4 rate hikes in 2022. See how these expectations have changed in a very short period of time. The Bank of England also should hike rates in February again. They have already started to do so in December. And the Fed could start reducing the size of its balance sheet very quickly. So you have to take into account the fact that the monthly net purchases will have already declined by $120 billion a month in less than 6 months by March. Same evolution for the ECB. The ECB doesn't plan to start hiking rates before mid-2023. That can change, but they will reduce their asset purchases from 19 billion euro at the end of 2021 to 20 billion euro by the end of this year. So in conclusion, since the spring of 2020, we can see that the financial markets have benefited from an exceptional environment with a sharp decline in real interest rates. They are deeply negative, plus an inflow of liquidity on markets never seen before, as you can see on the other graph. Sharp acceleration, and this will completely change in the coming months. And so far, we have a rather moderate impact on financial market. There has been a downward correction in equities. For example, the tech stocks, the Nasdaq has fallen by more than 10% compared to the November highs. But if you look at bond yields, they are on the rise, but they are still rather low. The US 10-year is nearing 2%, but it's still a rather moderate level. The German 10-year has just increased above zero for the first time since May 2020. It was 2019, but we are talking about rates that only are at zero. So I would insist on that. What happens if inflation appears out of control? I think we can have much damaging evolution on markets, and this is clearly the risk for 2022. So I'm now ready to answer some questions, Julien, if there are some.
One question to start. So you mentioned that inflation risks are the biggest threat for the global economy in 2022, but do you see other risks for the global economy?
Yeah, I think the other main risk, that I really didn't evoke at all, is about China. You know, China has entered a property crisis resulting from years of overinvestment. Property developers are really in big trouble. And the goal now of the Chinese authorities is to allow the downward adjustment to take place while supporting activity in order to guarantee some revenues for property developers, and in order to avoid a broad default that could trigger a broad financial crisis. So it's really a very difficult balance to find. So far that seems to be okay, but I'm not sure the situation is fully transparent in China. When you look at the evolution of activity, we can see already quite a sharp downward shock on activity at the end of last year. The activity in the construction on the property sector was down by around 15% on the month. So that is clearly, in my view, the biggest risk. You have, on the one hand, a clear slowdown in Chinese GDP growth that was more than 8% last year and should decline to something around 5 or maybe 5.5% this year. A big shock for the global economy. On top of that, you have always the risk of something that gets out of control and that could trigger on financial crisis.
Okay. Thank you, Olivier. A question regarding the US situation. So what is driving the disconnect between low US unemployment and high levels of employees voluntarily quitting their jobs?
I don't see any disconnection. I mean, you have a very low unemployment rate that is below 4%, and you have the power in employees' hand, and they are more numerous to voluntarily quitting their jobs because they think they can find something better that will be better paid in another jobs. So I think that seems quite logical.
All right. What is your view on the Euro USD rate in the coming months?
Yeah. So I think we had seen a rebound above nearly to nearly 115 in the last weeks. I think it was a bit exaggerated. I mean, that was counterintuitive because, of course, you can think that the dollar will have higher rates compared to the euro because of the policy, the relative evolution of policy between the Fed and the euro. But at the same time, you had a negative impact of higher inflation expectations weighing negatively on the currency because the prospects of probably lower real yields, on the US dollar. Now we have a downward correction with the euro dollar closer to 113. I'm not sure that this correction will continue either. I think we should rather have a kind of stabilization because of those two risks. I mean, on the one hand, you have the higher rates in the US, but also higher inflation expectations. So I think probably prospects of stabilization around 114 for the euro dollar in the coming months.
Okay, thank you. And just one last question before we switch to the oil part. So IFO is progressing sharply despite inflation. Why this paradox here?
I think it was obvious, for example, in the zoo survey yesterday. Because it's a bit different because zoo is not a survey among the businesses, but it's on the financial market. But you have a broad sense of optimism linked to the fact that the Omicron wave is expected to last a very limited period of time, and that there will be a rebound thereafter. I think what that tells us is that the inflation risk is underestimated. Probably for the German business confidence, they expect some improvement on the supply issues, in particular for the auto sector that has really suffered. Last year, the auto production in Germany was more than 10% below the production of 2020. That was already extremely low. Okay, but I think what you have to keep in mind is that people generally underestimate, I think, the inflation risk.
Okay, thanks a lot, Olivier, for these answers and this presentation. So we'll go back to the presentation, and it's time to move on to the oil market with Loïc Balland.
Yes. Hello, everyone. So I'll just jump right into it. So as you can see on the second chart, we're back into the strong rally on crude prices. And those crude prices are now close to $88 a barrel, so we're above November highs. And what we can say is that we are seeing that the oil system is getting increasingly short, when most observers were expecting the system to be a bit more long in this beginning of 2022, end of 2021. And you can see that on the first chart. When, for example, the EIA or OPEC expected stock builds in December and early Q1, satellite measurements are showing that the crude market is getting increasingly short. So you see stock draws in strategic petroleum reserves. You can see floating storage getting depleted. You can see oil in transit, so basically ships moving faster to their destination to deliver refiners quicker. And you can see onshore storage building a bit, but not enough to counteract. And this is really a surprise to the market. And we're going to see what fundamentals are driving this mismatch between expectations in Q3, Q4 21, and what we're currently experiencing. So on the demand side, as Olivier said, Omicron is not as destructive for demand as the previous waves due to the high vaccination coverage. And you can see that it also really surprised, I'd say, market participants. You can see on the first chart, gas oil stocks drawing a lot across the board, whether you look at Asia, Europe, US, it's really at a global scale. And we can more or less say that demand is back to pre-COVID level, except for jet demand. So aviation is the big missing piece. But as you can see, the Omicron wave had a very little effect on global jet demand. That's the second chart you can see on the gray area. So when Omicron reaches level daily cases comparable to other waves, there's just very little effect on jet demand. And the pent-up demand that is available for incremental growth is still quite big. You can see there's a 2.5 million barrels per day upside on the global jet demand. In terms of forecast of global demand, we think we're going to be back to pre-COVID level this year. And so this global jet demand is going to increase back to levels experienced in 2019 during the summer of 22. But it's not only demand that is outperforming. Supply is also plagued by a lot of disruption early this year. So you can see that whether you look in Libya, where there's exports that are underperforming, or you look at Nigeria with outage on pipelines and so on, you can really see that the system is getting more tense. On the first chart, you can see this is West African crude price against North Sea barrels. And since the beginning of the year, you can see it's soaring. We haven't seen that since, let's say, COVID, since COVID hit. And it's really a strong sign for the physical market. What's going to respond to this demand is going to be inventories once again. And you can see on the second chart, this is the crude time spreads. And we still expect those to rally to really guide the pace of the stock depletion, because the stocks are the only supply, marginal supply available to really address the demand. Furthermore, for 2022, we have a lot of uncertainty around how much spare capacity OPEC producers actually have. Whether you look at Kuwait, Russia, or West African producers, they seem to increasingly get closer to the limit, and the monthly OPEC increase that they're allowed to produce is not consumed to the full extent. So also a concerning aspect on the supply side. So with that, there's also potential downside price risk. And we're going to see here what could weather this continued increase in price of crude. So the biggest factor remains US production growth. You can see on the first chart that since COVID hit, we had a big downturn in US production. And we're anticipating that US production in 22 will be at 12.1 in December. But if you were to, let's say, have a stronger production, so here you can see the high case where we go, where the exit rate is at 13 million barrels per day in the end of 23. You can see that we're actually not building or drawing inventories globally. So you can see on the second chart, and we stay at the current situation in terms of storage. So that would be an upside risk, an upside potential for growth in production. And this has really surprised the market in previous years. So for example, in 2018, we were continuously surprised by US production, and same happened for other years. So clearly a factor that could limit the rise in crude prices. Finally, from the part of oil consumers, so whether you look at Europe, US, or Asian countries, there's a few levers that can be pulled, but not a lot. So on the first, there could be easing of economic sanctions for Iran and Venezuela. So we're assuming a pretty conservative growth in Iranian and Venezuelan production, but it could go faster if the US were to speed up the process for the Iranian nuclear deal. That's a clear downside risk for prices. There's already a lot of smuggling from Venezuela and Iran to oil consumers, but it could be at a greater pace if the US were to decide to speed up the process. The second thing is that, as we saw in 21, oil consumers can decide to use their strategic reserves to draw on their stocks and supply the market. That's a very speculative way for government to address this crisis, because we're more in a structural issue rather than a temporary one. And finally, you can see on the second chart whether crude prices are at $88 a barrel, but if you look at price at the pump for many oil-consuming countries, whether it's in Europe or Asia, we're at a record high currently. So there's going to be here political tension revolving around fuel prices, and there could be also effect on whether countries decide to lower the tax duties or we have outright demand destruction because of high prices. So that's the three levers that oil-consuming countries have to weather the rise in prices. In terms of outlook for prices, we see that the system is not really balanced in H1, so we're drawing in the first part of the year, and then we're building stocks in H2 due to US production rising. And so we have a risk of price spike during H1. So price spike meaning that we go maybe above 80 or 90 or 95. But then in H2, prices should ease as the system gets a more balanced path going forward. Last thing, we have speculative positioning that is quite low, as you can see on the second chart. When you look at the net long exposure from money managers, and that's also a factor that could be bullish if manager were to pile on future contracts, as, for example, when you see poor return on other financial assets, they could kind of try to ride the inflation and high commodity price trend. That could also be a fairly bullish factor. Yeah, that's it. If you have any question.
Yes, we have some questions from the audience. So first one, what is the current crude production level for Russia and Saudi Arabia?
Yeah.
US at 11 million barrels per day, as you said. Where do you see volume production coming in the next months and years?
Yeah, so Russia and Saudi Arabia are allowed to pump about 10.3, 10.4 million barrels per day, both. And so Russia is a bit below its target, while Saudi Arabia is more or less always in line with its target. And the US, so we are currently at 11.7. And the fact that we are growing only at 12.2, which is still a 0.5 million barrels per day increase, so it's significant. But the fact that we only go there is due to rather poor investments in US E&P, first. And second, the fact that there's the number of drilled uncompleted wells are falling quite fast. And so the growth in production that they could have for free, let's say in 2021, won't be free in 2022. They're going to have to reinvest quite massively to produce and even maintain the current production. So with that, the exit rate may be a bit underwhelming compared to historical norms, but it's due to the poor investment in the space.
Thank you. Second question, which can be also a transition to the next part of the webinar. So if gas prices are going down more and more thanks to smoother geopolitical situation, then the gas to oil switch will reverse, releasing more crude spare than lower oil price. Do you agree? So maybe you can remind us about the estimate of the increase in oil demand links to the sharp spike in gas prices overall.
Sure. So far, so that was a subject that was really a topical issue back in autumn of fall of 2021. In reality, the potential for switching from natural gas burn to oil burn was mostly in Asia. And given that in Asia we have we don't have cold snaps at the moment, and we think that during the whole winter it's going to be very unlikely. We don't have a lot of oil to gas burn, which is really the marginal supplier of power at the very end, because it's quite expensive. So the oil to gas switch seems to be quite poor. The main one was potentially Japan, but it's not as good as not as big as most thought. And yeah, so it's something that will probably not be significant.
Okay, another question. Should Iran come back on the market, would the country replace other crude production, or would it meet opportunistic additional demand?
So yeah, that's an interesting question. So Iran is already more or less supplying China. It's just that the crude is smuggled, and so they're offered at steep discount compared to the global market. The flows are very speculative. It's hard to say how much really is there, but some would say that it's between 100 and 200 KBD a month. KBD. And so when Iran come back, and it come back in our forecast and so on, it will only maintain the level of stocks at the moment. So it addresses a demand that is already there, but this demand is currently addressed by stocks drawing. So it's unsustainable. So it's gonna, in a way, meet additional demand the demand that we're currently addressing with stocks.
Okay, and one last question to close this Q&A session. And so, do you think that the structural low level of investments in oil markets will have an impact on oil supply in the medium term? And thus on
yeah, I mean, I think it's been now probably 5 years of even maybe 7 years that a lot of people are pointing towards the low investments as a key risk for longer term prices to be high. I think we're seeing that materializing now. You see across the forward curve steep increase in prices. You also see less pressure from producers to hedge. So the long-term prices are allowed to, let's say, rally a bit more. And I think that high prices will probably have a big effect on investment. You got to look at long-dated futures, and the move in those prices will ultimately determine the level of investments. The fact that it's a sector that people don't want to invest in will probably be resolved by higher returns on investment. So I don't think there's going to be really an issue. It's just going to be solved by prices, specifically long-dated prices.
Okay, thank you, Loic, for this presentation and your answers.
Thanks.
It's time to move back to the presentation with Évariste for the natural gas section. Yeah, hello, Évariste, we can hear you.
So, hello, everybody. Let's start the presentation on the gas market. To begin, we'll just come back to some reason explaining why, since the start of the year, we are seeing this downtrend in prices. The main factor is clearly the moderation of Asian LNG imports. You have here the three major world importers: China, Japan, and South Korea. And as a reminder, last year, China became #1 LNG importer before Japan. And what is interesting in this one is to see that in December, China saw its LNG imports dropping. This was a surprise, because if you look at the graph since the start of the year, we were at rather huge levels in terms of increase. But gradually, you saw the slowdown ending in December with a drop. In Japan, in fact, the slowdown started earlier. It started in August. And for the whole 2021 year, you see that Japan saw a drop in its LNG imports, or a stabilization in its LNG imports. For South Korea, we were up year on year globally for 2021, although for this country as well, we saw a slowdown. So overall, noticeable slowdown in Asia LNG imports, helping the European gas market to be much more comfortable, at least on the supply side. Russian flows remained weak. You see it when you look at the graph on top left. Still very weak until the end of the year. But in the context of the slowdown in LNG imports in Asia, and also the rebound, strong rebound in Norwegian flows. Look at the graph on bottom left. Europe managed to take more LNG, and also Europe managed to reduce the supply deficit, as we'll see it on the next slide. The supply deficit is still strong, but if you look at the trend in net storage withdrawals at the end of the year, we even managed to have some net injections, meaning that we switched from net withdrawal to net injections, which is quite unusual during the winter, just to, as a way to show that the balance was a little bit less tight, thanks to LNG and also thanks to LNG and Norwegian supply. But the supply, the storage deficit is still there. Just look at the graph on the right, and we believe that we should maintain this trend until end of March. This has an impact on prices. It just means that during the summer, given the low stock levels we'll have end of March, we still need huge injection demand to fill storages. The price impact is clearly to say that we will still need power generation to reduce its demand, meaning that gas prices should continue to trade above the coal parity level, which is the condition to destroy gas demand in the power generation sector. So this will set our minimum. The question now is where can be the maximum for gas prices? The maximum for gas prices, you can look at it by looking at the 1 year range. This is the current situation. Now we were at rather huge levels until mid-December. As a reminder, prices reached their high on the 21st of December. We were at 188. After that, they drop. They drop, as we say, thanks to high LNG supply, thanks to strong Norwegian flows, and also thanks to mild weather at the end of the year. They drop, and more important, they drop below what we estimate to be the 1 year high. You all know the 1 year average. The 1 year average is easy to compute. The 1 year high is computed using daily prices and also the volatility. You have a formula to compute it. Roughly, it will be around the average plus volatility. And on the opposite, the 1 year low will be roughly the average minus the volatility. So prices are now back inside this trading range we estimate to be the normal one. The question is, will they continue to drop, or can they come back again close to the 1 year high or even above? If we maintain the current slope of the trend, let us say the slope of the 1 year average, at the end of this year, at the end of 2022, the 1 year average will be at 150. And the 1 year high will be at 285. These are huge numbers, and I believe that maybe if I if I take the survey made by Julien at the beginning, maybe most of you don't believe that we can reach such levels at the end of this year. Me too. I cannot imagine the market prices reaching such levels. So hard to imagine to see the 1 year trend to maintain at such levels. But be careful. Recent experience has shown us that what we can estimate to be unimaginable can happen. Therefore, if you have an assertion about some impossible prices, it's better to back this assertion by fundamentals, and in particular by positioning gas in the global energy mix. That's what we'll try to do now. So, if you look at the title, you already have our answer. We believe that some fundamentals should exert downward pressure on prices, both on the short term and the long term. Just let us start with the table on the left. This table gives you the whole primary energy consumption and also some values about LNG supply. Although we don't have the final values for 2021 yet, preliminary values give us some interesting messages. And the main one being that last year, gas consumption increased less than consumption for coal or oil. This is unusual because in the previous years and for years now, gas consumption was increasing more than coal or oil consumption. Obviously, last year there was a price effect. We believe that because of high gas prices, yes, we had demand destruction. Demand destruction happened in the coal market. Think about China for sure, but also demand destruction happened in the oil market. It is difficult to assess, and Loic talk about it clearly. To assess the reality of the destruction by oil, but we are sure there is some. We have the figures showing that there is some. So let's come back to coal, because demand destruction in the power generation sector seems to be the most significant one. Just some numbers. Last year, China coal production increased strongly, and this increase was mainly done by the end of the year, when China decided to increase strongly its production, just to cope with the power crisis. And in December, coal production in China hit a record level. We were at more than plus 7% year on year, and for the full year, we were also very high. And last week, Chinese authorities started to tell to coal producers that they have to maintain the effort. And here we just put what they ask them to do, even for the Lunar New Year holiday. They are obliged to continue to produce at record levels, even during that holiday. Just to tell you that for this year, 2022, we continue to believe that China coal production should remain robust, because China should continue to want to fight high prices. So we can, in our assumption for the coal market for this year, continue to say that coal production will be strong, driving high coal consumption in China, and hopefully reducing a little bit the pressure on the LNG market. The same for Indonesia. Maybe you heard about the coal export ban by Indonesia since the start of this year. Yes, they started to ease the ban. And again, this week, Indonesian authorities say that their target for this year, an increase in coal production by around 8% year on year. So on the coal side, we believe that for sure there should be, again this year, some bearish pressure coming from the coal market and exerting a downward pressure on gas prices. Some word on oil again, apart from demand destruction in power generation, you have also demand destruction in road transport. I believe that this is not usually highlighted, but you have some gas being consumed for road transport, and in particular in China, but also in India. And most of this consumption is done in the taxi market. We believe that for that you can have substitution more easily, because if your taxi is being seeing expensive costs due to the gas, maybe you can just switch, or you can just stop the taxi and use all the taxis using gas oil or gasoline. So we have to be careful about this. We are monitoring this market again quite on a daily basis now, because when you talk about 21 BCM of consumption in China, this is around 20% of the China LNG market. So as a conclusion, on the short term, we do believe that demand destruction should continue to set a cap to gas prices. As we say, market prices will be above the coal parity levels, of course, because we still need to destroy gas in the power generation sector. And we believe that the equilibrium could be around gas oil prices. In the long term, you have a question. When you talk about long term, you are talking about maybe the possibility to have green gases. There are a lot of hopes on green gases, hydrogen or biomethane. And the hopes are on the volumes, higher volumes. The hopes are also on lower production costs. If these hopes materialize, it just means that gray gas will face strong competition, with prices possibly weakening just because they will be discounted by competition, but also discounted by the level of carbon cost. This means that gradually green gas could become the benchmark, the reference for the gas market, and set the marginal price. Given the huge volume to replace, you can have two scenarios. Why such huge volumes? Just come back to the table we show. As a reminder, if you take biomethane, for instance, for the time being, for the European Union, biomethane should be around 1 or 2% of consumption. This is quite low. You can have the same for hydrogen, meaning that if you want to switch our consumption to greener gas, you'll need a lot of volumes, and this could lead to strong competition if all the geographies, let's take Asia, on their side, they also want to make their gas greener. So the first scenario is the scenario of a single global gas market. In this scenario, we'll have strong competition for green gases and possibly higher prices. The other scenario is the scenario of a split of the gas market, with an area of gray gas, another area of green gas. We don't know yet what scenario will happen, but globally, we can say that if you sum up the short term and the long term the long term trends, you can end with the conclusion that, remember what we talk about the 1 year trend. We can conclude that we don't believe that the 1 year trend will maintain at such levels with such a huge slope. Having said that, the question is, when do we expect the trend reversal? So when do we expect prices to break below their 1 year average? To answer that question, of course, we can do it by ourselves, but I believe it is better to look at what the market is thinking right now. And what the market is thinking right now is summarized in the forward curve. Just look at the graph on the left. Here you have the historical values and also the forward curve as of the 17th of January. And what the market is telling us is that it expects prices to cross below the 1 year average in April. In April, I should mention the April contract, which will trade as the first nearby in March. So the market is sending a signal to us. Just look at the graph again carefully. We are very high currently, close to gas oil levels. We believe that these gas oil levels, for a set of reasons we already mentioned, should remain the trading range, maintaining gas prices above coal parity levels. But the market believes that from the April contract, we will drop below this 1 year average, meaning that we'll have a trend reversal from that period. Why is April so important? Why is April a key turning point? Just because it is when we'll know if the current concern about low stocks levels are behind us. The market seems to believe that given weaker Asian prices, we'll continue to have high LNG flows to Europe, and these high LNG flows will enable Europe to fill its storages. This is the current belief of the market. For next winter, you can have additional downward pressure coming this time from the pipeline supply, from Russia in particular, as we expect that by the end of the year, normally Nord Stream 2 should start. If these assumptions hold, of course, in the coming days, the coming weeks, particularly in March, we will see this trend reversal. But of course, if they do not hold, prices could remain above the 1 year average, especially if oil prices turn out to be more bullish than expected, because as Loic mentioned, there is a risk on the oil side, particularly because oil demand is performing quite well compared to expectations, just because I believe that there is also some demand destruction in favor of oil. If you look at further ahead, just look at the graph on the right. Here we are talking about more distant maturities. Of course, these maturities will follow what will happen on the spot and the near curve, but they will also follow what will happen on the green gas supply, particularly for more distant maturities. When you talk about 26, for instance, for those maturities, of course, if you have an inflow of green gases at rather low prices, you can have also a downward pressure. So if you believe that this scenario of a trend reversal is the most likely one, trend reversal in the very short term, particularly in March, then what I'll say is to be careful and to monitor clearly the assumptions and to see if your assumptions are still valid. One way to monitor it clearly is to look at what will happen in the shape of the near curve. Again, here you can put the 1 year high, 1 year average. I didn't put the 1 year low because it is too low and not relevant for the time being. And then you can also look at what will happen on the 20-day range and also on the 5-day range. These are the three range we use to monitor this market. The 1 year, the 20-day, 1 year because it's the 1 year time frame, the 20-day because it's a monthly, and the 5-day because it is a weekly. So you have a weekly, monthly, and yearly time frame to monitor the market. So what the market is telling us is that gradually we are coming back to normalization. As a reminder, what I believe to be a normal trajectory is prices trading inside the 5-day range, the latter lying inside the 20-day range, and even we can add the 20-day range lying inside the 1 year range. Here you have the near curve. Prices dropped quite significantly recently. They rose again. Of course, normal. They are trying to get back inside the normal range. And more interesting, what we talk about the turning point, which is April, you can see it here on a daily basis. You can see it here on a daily basis. Just look at March. Just from the 28th of February, the April contract will become the first nearby. And you see that the market believe that from that period, you'll have a drop. You see the orange line, the drop is the drop of the April contract. And this drop will gradually pull this price, just because prices will continue to drop while the 1 year average will increase a little bit. And in the course of March, we'll see this drop. So to confirm that the market continues to be bearish, my advice would be to monitor clearly what is happening on the shape of the curve on a daily basis to see if the trend reversal we are expecting from March, in the course of March, I'll say, is still relevant. So this is on a let us say 1 year, one month time frame. You can do the same in the very short term. This is a graph we are now usually showing in our daily for the one who are receiving and reading the daily report. Again, we use the same levels. You have the 20-day levels, high and low, average, and you can compare them to the 5-day range, high, low, and average. In the past days, you saw that prices were dropping a little bit, but also finding some support. The support is clearly coming from the 5-day low. It is normal, even in a dropping market, to see prices rebounding from time to time. Why I am saying that? Just because in general we tend to have some requests from it could be from you or from clients or from even our sales saying that yes, what is happening, prices are dropping today. Yes, even in a downtrend, prices can still rebound. This is what we say technical rebound. If you look at the trend, for instance, for last I did the slide yesterday, so today was in fact yesterday, and you see that the day after prices drop a little bit. They drop a little bit, but they found a support. So it was normal yesterday to see a kind of rebound. It did not change the trend. It was just that prices dropped too much. Some financial participants reached their target. They were sellers. They reached the target at the 5-day low. So they were buying back their position. This can help prices to rebound. But if the trend is still bearish, it means that the rebound should remain limited. And clearly, actually, yesterday the rebound was rather minor, both on the spot, the first nearby, and the calendar contract. So we are still in a bearish trend. So the trend reversal we are expecting, the market is expecting, the forward curve is expecting for the April contract is still valid. But you have to look at such indicators on a daily basis to see if the trend could be invalidated. And the first step for a trend to be invalidated is clearly the 5-day average rising and crossing above the 20-day average. It's not the case yet. So for the time being, yes, the market expects a trend reversal from the April contract. Yes, fundamentals are backing this trend reversal, particularly what is happening in Asia, but you have to monitor closely those fundamentals, those price levels to see if this trend reversal is still valid. So that's it. Julia, I don't know if you have some questions for me.
From the audience, let me display that. Yeah, so a question regarding the geopolitical risk and especially the recent news and geopolitical talks between the US and Russia about Ukraine. So what do you expect can happen on the gas market if Russian troops step into Ukraine? Is there a risk that Gazprom exports to Western Europe drop significantly?
Yes, there is a risk of a drop for sure. And even if you don't have an actual drop, I think that the risk premium will be huge, because you know that the market maybe doesn't need to see a clear drop of flows to react. So as soon as you'll have the news on Reuters saying that yes, Russia is invading Ukraine, I'm afraid that prices will react, because some market participants will have a clear interpretation. No? They say that okay, risk premium, there is an upside, boom, I will be buying whatever the price. And in this configuration, the huge levels, the impossible levels we are talking about. Remember the 1 year average at around 150, or the high at 285. Yes, in this configuration, at least temporarily, you can jump to such levels.
Okay. Another question: do you believe there is a risk of depleting the storage?
If you maintain the current trend, strong Norwegian flows, although they were disturbed recently by some unplanned outages, but if you maintain the flows from Norway and from LNG, and in a normal weather configuration, no, the risk is very weak. But if you have some additional problems in Norway, additional outages, or a surge in an unexpected surge in Asian prices, yes, you can have a risk not to have a full depletion, but to come back to storage levels at rather historical lows, close to the levels of 2018, for instance.
Okay, thank you. And one last question. So does the one single global gas market you mentioned in one slide mean guarantee of origin on green gas?
Yes, it includes also all the let us say the tools that are around this green gas. Yes, if you have one single market, of course, you have also to monitor how you will manage the guarantees of origin. So this one you can only have it if you have one single market.
Okay, and just one last question: what does the market expect at this point on the situation of Nord Stream 2?
What the market expect, I don't know. But if I look at the forward curve, maybe I did not mention it because I mentioned the turning point in April, meaning that yes, in April we believe that the summer will be comfortable. We'll have enough supply to fill our stocks. But if you look at the curve, so you can look at the slide afterwards if you want. You see that even for the winter, you have a jump. This is the seasonal jump you have during the winter, but prices remain below the 1 year average. For me, this means that the market expects some additional flows coming from Russia. So the market is expecting higher Russian flows, either via Nord Stream 2 or via the usual routes. If it is not the case, if you don't have additional Russian flows, even during next winter, yes, you can see an upturn in prices.
Okay, thank you, Evariste, for your answers. I see there are other questions that we'll answer by email after the presentation, as we are running short on time. We have to switch to the power section of this presentation with Etienne Covin.
Yes.
The floor is yours.
Are you hearing me well?
Yeah, we can hear you.
Thank you, Julien. Hello, everyone. Glad to see you back all for our quarterly webinar. So as you all know, 2021 has been particularly tough for commodities with extreme volatility and high water prices, to say the least. And unfortunately, the power and carbon markets were not spared by the crisis either. But today, I'm still going to try to answer the very difficult question, that is, what to expect in 2022. And as usual, I propose to start with the carbon market. So let's start with a quick look back of last year that would help you identify and understand what could be the drivers of prices for the upcoming months. So as you can see on the chart with the blue curve, the carbon prices have presented in 2021 a massive bullish rally that drove them up by no less than 145%, and even more if you count intraday highs. But what drove prices to rise by such extent? Actually, we can attribute the sharper trend to three main factors, and one, of course, publication, very important, the Fit for 55 publication. So the first main bullish factor is represented by the green curve, which actually represents the number of investment funds holding a position on the ICE. And as you can see, 2021 was marked by a large inflow of investors, non-compliance players, who injected a large amount of proprietary money in the market. But what attracted all of these investors into the market? Basically, with a newly raised 55% 2030 emissions reduction target of the EU that was raised last year in 2020, late in 2020, these non-compliance players saw the EU ETS as a one-way bet. And by that I mean they anticipated that the European Union would likely use its most efficient tool to reach this much more ambitious goal, the EU ETS, and that it will likely result in a much tighter supply of carbon allowances over the next decade. And a rapidly decreasing supply facing a much slower drop of demand, since carbon abatement need long-term investments and expensive investments. This would mechanically drive the prices up, and hence the investors saw the carbon market as a good investment opportunity with a very attractive risk-reward trade-off. The second main bullish factor is, of course, materialized by the red curve, which represents the gas prices. And as you can see, they spiked quite vividly over the second semester of 2021. And basically, it pushed all the gas power plants out of the stack. So what I mean by that is that they made the coal power plants more competitive than the gas ones. And since the coal power plants are more emitting, it increased the demand for carbon allowances. And lastly, and you can see it from November to early December, you can see prices rose by 55% in less than 6 weeks. But this time it was mainly due to option trading and technical trading. It was not really supported by any fundamentals. But it was nonetheless a quite sharp uptrend, and it's important to notice it and to remember it because we could actually see a similar uptrend in 2022. Okay, so now that you have 2021 well in mind, let's go over what we can expect in the upcoming months. And first, the supply. And unfortunately, I'm sorry, but I will not be a bearer of good news there, because as you could expect, the supply is going to be lower again this year. So let's have a look at the upper left chart. So as you can see in gray and blue, you have your auction volume So volumes that were sold through auctions in 2020 and 2021. And in orange, you have your volumes scheduled to be sold through auction in 2022. Let's not forget that the year is divided in two. So the volume set from January to August are fixed. There will be the actual volume sold, but the volume scheduled from September to December are actually subject to change with the MSR application. So basically, mid-May, the market surplus is calculated with the TNAC. And based on this amount, if it exceeds the 833 million tons, which we expect this year again, the auction volumes from September 22 to August 23 will be reduced accordingly by 24%. But what is interesting is that we already see auction volumes to be lower. So both on the first part of the year, as you can see, it will drop by 21% year on year. But we also expect it to be lower, since even taking into account the pre-MSR application volumes in light blue, you can see that the volumes for 2022 are already lower. But what's interesting is that we expect the MSR withdrawal this year to be actually lower than last year. So basically, the volumes reduction should be quite lower for two reasons. The first one is, of course, due to the gas to coal switch that we have seen since September last year. Basically, it increased the emissions and the demand for allowances. And the second one was, of course, because in 2020, we had a lot of lockdown, which strongly reduced the emissions from the industry and power generation sectors. And since both factors are increased the emissions in 2021, they forced participants to use part of their surplus. And hence, it should reduce the overall market surplus in 2021. And hence, the volume cut from the auction from September to December being based on this surplus, the cut should be lower. So it's still a huge bullish factor for prices for this year, because the volume will be quite significantly low at the end of the year also. But it could prevent prices from going too high. At least the cut should be lower than last year. Okay. Looking forward now, and I invite you to look at the right chart. So basically, the bar chart represents the verified emissions over the past years, and the curve represents the cap. So grossly represents the supply of allowances for the upcoming years and for the past years. The light blue curve represents the current cap of the EU ETS, which has been adjusted in 2021, as you can see, due to the departure of the British installations in the Brexit. And the red curve is the new ETS cap proposed by the European Commission in its Fit for 55 package. And as you can see, if it's actually implemented as it is proposed, the supply of allowances should reduce quite drastically over the next decade. And of course, a lower supply would mean a support for prices. So overall, you can expect the supply side of the market to be quite supportive, both in the short term and the long term this year. And in the long term. Now looking at the demand. So as you may not know, for the EU ETS, the demand can be categorized into two parts. The first one made of the actual emitters, so basically your power plants, your heating plants, and your industries. And the second one, the investors. So first, let's have a look at the emitters. And we are quite in a complex but very interesting situation there. So first, looking at the left chart, which represents the coal to gas switch range. So just a quick explanation. The switch range is based on the gas and coal prices. You have the spot prices on the left and the current forward curve on the right. And basically, when you have your carbon prices below the range, carbon prices are represented by the red curve. So when they are below the range, it means that the coal power plants are more competitive than the gas one. When the carbon prices are above the range, it means that all the gas power plants are more competitive than the gas one. And when it's in the middle, like for 2023, as you can see, it depends on each efficiency of each power plant. What is interesting to notice is that, as you can see, all the coal power plants are more competitive than the gas one since September and until Q2 2023. So you could expect emissions to be higher this year, especially in the first semester compared to last year. But it actually does not imply a strong support for prices. And why is that? Well, because we can expect the coal-based power generation for 2022 to be mostly hedged by now. That means that the potential for further gas to coal switch, which was one of the bullish factors of 2021, is now exhausted from 2022. So basically, it's still supportive to prices, but we do not expect this factor to push prices further up. There are other bullish factors in the carbon market for this year. So the first one is, of course, the nuclear situation, both in France and its neighbor countries. So first, perhaps the quicker one, as you all know, Germany planned to phase out all its nuclear capacity, and it already closed 4 gigawatts of capacity late 2021. It's closed in January 2022. Sorry, there is a typo there, which is quite significant, of course, and it should increase the demand for the thermal power plants. And I'm spoiling you a bit the presentation here. When you look at the right chart, which represents the French nuclear generation and the remit availability and what we expect in the upcoming months, and as you can see with the red curve on the left on the chart, the actual nuclear generation in France is quite catastrophic so far in 2022. And when you look at the blue dashed curve, which represents the remit availability, it's already historically low and it's already near the historical range of production. And as the remit availability does not include any unplanned outage, you can expect the generation to be even lower than the current level of availability. And it's quite catastrophic, and it should also increase the demand for the thermal power plants. So really, the nuclear situation on the, let's say, utility side is the main support of prices this year. But there are actually bearish risks also. As Évariste told you, there are really bearish risks from the gas market. So actually, we could see some potential pressure with the start of Nord Stream 2 if it increases the gas storage enough, and we see, the situation and the gas tension eased for the end of the year. And since it's likely to push gas power plants back into the stack, it could have some weight on the carbon market as well, but it's a very hypothetical situation. On the longer term, so far the industry has been quite protected from the extreme energy prices. Basically, you have all heard about some power plants, no, not some power plants, but some industry closing due to the high energy prices, but it's very marginal. And overall, the demand was quite steady, did not move despite this spike of energy prices. And why is that? Well, mainly because all their production and needs were already hedged for 2022. So they were already protected. But as these hedges roll off, so basically as we enter into 2023 and 2024, due to the very high current energy prices, it might be difficult or at least more expensive for them to maintain those high level of hedges. So we could see this demand decrease, let's say, in the longer term. And this could weigh as well on the power market, on the carbon market, sorry. And finally, at the end of the year, we expect further closure of nuclear capacity, but I will get back to that in the power side. So basically, what I mean by this slide is that fundamentally, the drivers are mixed. Basically, we have a stronger support, which should limit any downside potential. But on the other hand, we could see some pressure from the gas market. So we are rather neutral in terms of purely emitting factors. But now let's have a look at what the investor could do this year. And unfortunately, the market could be once again in the hand of investors this year due to the, in part, neutral aspect of the emitters. So first, we expect a lot of volatility this year due to the ongoing Fit for 55 negotiation, of course. But in terms of actual uptrend, we expect it to be more progressive. And why is that? Well, first, because the risk-reward trade-off is less attractive currently than it was last year. So basically, currently the prices are hovering between 80 and 95 euros per ton, while at the same moment last year, prices were only just above 30 euros per ton. So when you see all Andron Capital and all these other investment funds speculate on the potential, direction of prices and say, which was one actually factors that push prices up, say carbon prices can go up to 100 euros by the end of the year. Well, we're actually close to those 100 euros per ton. So it would be foolish to say carbon prices cannot go further up and cannot surge again. But the upside potential is actually more limited than it was last year. Otherwise, we also have higher cost of derivatives. So basically, the even the playing cost of the underlying DEC 22 is much higher. But we also saw the ICE, the main market exchange, raised its margin requirements by 20% early 2022. So it means that it's really more expensive for speculators to build long positions. And actually, you can see it already with the upper right chart. So you have in blue again the carbon prices. In green, you have the net long position of the emitters, and in red, you have the net position of the speculators. So basically, investment funds and other financial institutions. And as you can see, they are starting the year with a net long position below what it was last year at the same moment, which could suggest that they see less upside potential in the carbon market. But it also can suggest that it's simply more expensive to build long position. It's still a bit early to draw conclusion on this, but it could be a first indicator that the market could face less upside this year. On the other hand, we have option trading, and I already talked to you about it for last year. Basically, it really drove the price way up in November and early December. And actually, we could see a similar phenomenon happen in March, because when you look at the option open interest, so the open interest is the number of open contracts, you can see that the call with 100 euros per ton strike price are again the one with the larger open interest, even though it's really low compared to what we've seen last year, because at the end of, let's say, early December, the open interest was at 40K. So we had 40K, 40,000 contracts open of coal strike price at ZAC strike price, sorry. And today we are only at 12K for the March delivery, but let's not forget we are only early in the quarter. And if the fundamentals are really neutral by March, we could actually see investors and option traders try to push prices toward this strike price. So basically in March, if everything else is rather neutral or really, little change, you could see a similar phenomenon that we have seen in November. You could see prices suddenly surge towards 100 euros per ton. So do not worry if it occurs. It could be only temporary. Let's not forget that the fundamentals are quite supportive, but so it should limit in any case the strong correction. But if prices are surging, it could only mean that option traders are attempting to reach the 100 euros per ton. And otherwise, the policy, of course, will remain supportive because we still expect a strong reduction of the cap with the 50 or 55 proposal. We see the parliament, we likely see the parliament push for stricter reforms. And on the other hand, the council should take the side of the commission in terms of proposals. And finally, and this is also important to remember, all the negotiations around the CBAM and the free allocation phase-out should incent the compliance buyers to hold on their allowances, and hence it should limit the number of sellers in the market. And if you have very limited sellers, prices can go up very quickly. You can basically corner the market. Okay, so a quick sum up, because I know it's a lot of information and it's always good to have a holistic view of all the drivers we can expect for the next years. So the main message is you can expect a strong volatility, which I attempted to represent by the gray area on the chart. And I think I'm still quite optimistic. So you have, of course, your ongoing Fit for 55 negotiations. You have option trading, as I've just told you about, which could trigger temporary buying bust, basically short-lived wide moves. You also have fundamentally your nervous gas and power markets due to all the uncertainties regarding the gas supply and the nuclear availability. And finally, but it's on the longer term, you could have an increased spot exposure once the hedges roll off. And basically, since it will be more expensive and more difficult, let's say, to build high hedges, you could see utilities and other industries face higher spot exposure, meaning that the weather, for instance, the power demand on the short term could have a stronger impact on carbon prices. Basically, when it's cold and there are not a lot of renewables, you can see prices go up, and the opposite will be true as well. Instead of seeing a really sharp uptrend as we have seen in 2021, we are expecting more of a consolidation and a progressive increase. Basically, we still have a lot of support from the lower supply of carbon allowances. We have a weak nuclear availability and a bleak outlook of it, actually, that should keep a strong call for thermal power plants. We have a lot of sellers due to the anticipation of free allocation and tighter supply in both in the short and the long term. We still have some gas to coal switch potential for the deliveries beyond 23 and in 2023. So basically it means that if suddenly the gas prices started to rise again for such deliveries, we could see some edges of coal power production. On the policy side, we see the intervention from the European Commission to curb the speculation. You know, we always see a lot of rumor regarding this subject, but we see it as really highly unlikely. And why is that? Well, because at the current level of price, even if for a lot of market participants, prices are really high, they are actually not high enough to trigger enough carbon abatement. So basically, even for the carbon capture storage project, it would need prices to go way above 100 euros per ton before triggering significant investments that could, let's say, make the EU ETS really efficient on the industry side. Of course, I'm not talking about the power generation side. But on the other hand, we still have resistances this year with a less attractive risk reward for the investors. We have higher cost of derivatives, making building long position more difficult or more expensive at least. The gas is already out of stock until Q2 2023, and with all production already, or at least mostly hedged, that leave little additional support, at least on this side. We have lower uncertainties regarding the Fit for 55 proposal, because what's interesting to notice is that over the first semesters of 2021, it was all the rumors, and basically we didn't know how the European Commission would propose to reach the Fit for the 55 2030 target. But not that we know, it's only negotiations, so it's basically noise. But we have a pretty clear idea of what could look like the carbon market in the upcoming decade, even though there are some reforms still under negotiations. And finally, you could see some possible industrial slowdown late 2022-2023 if the energy prices remain high and the hedges are no longer there. Now moving to the power side. I'll try to be quick because I see the time running. So regarding the short term, both demand and spot prices, I think the chart here are pretty self-explanatory. So let's have a look at the left chart, which represents the aggregate monthly average power demand for Germany, France, Belgium, and the Netherlands. And as you can see, in 2021, the demand has been quite within the historical range. Of course, it was higher than 2020 because we had much less lockdown, but it was pretty average overall. On the other hand, if you look at the power spot price, which are presented by both charts on the right, you can see that prices really spiked and really reached record high levels in 2021, especially over the second semester. And there are two reasons for that. So maybe have a look at the right chart, where you can see average prices, and also in the black dotted curve, the average clean gas cost, so basically the cost to produce 1 megawatt hour of electricity from gas power plants. And it appears pretty clearly that the famous clean gas cost push the power spot prices to such high levels. And also at the end of the year, and I will talk more about it in the next slide, we had a very weak nuclear availability that increased the production from the more expensive thermal power plants. And so both factors push prices to record level. Now looking at the nuclear situation, which I'm sure you are all wondering about. So as you can see on the upper right chart, again, you have your production in red, and in blue, your remit availability expected for the year. And as you can see, for last year, despite a pretty good recovery in Q2 and Q3, we had the nuclear production in France drop below the historical range from November, and especially in December. So why is that? Well, basically, EDF discovered corroded pipes in the safety injection system at its CIVO units, basically let's say 3 gigawatts for the two units, one of the most powerful units the French utility has. And its other units, choose 1 and 2, sharing the same technology. It decided to stop them in order to investigate to see if there was the possibility of finding a similar default. And it also found later a similar default on Penly 1, another quite large nuclear power plants. So basically, it reduced the nuclear availability by 7.3 gigawatts for the critical winter period. And that is why we are currently seeing a really weak nuclear production below 50 gigawatts, which we have never seen so far. So for all those units, EDF extended the outages or put them into outage by up to 9 months, with a restart schedule from May for Penly and much later for the other units. And the ISN, which is the nuclear authority, required a full assessment of EDF's reactor by the end of January, which could actually trigger extra closure of units in the upcoming months. So not really a very positive outlook. So far, the impact is mostly for Q2 and Q3 this year, but we could actually see this summer additional outages for fuel saving. We know EDF will probably attempt to optimize the availability for the next winter, but we are already expecting a very, very weak availability in Q4 2022, even though the remit is not showing currently. So consequently to this event, EDF revised down its nuclear output target for 2022 from 333 to 360 terawatt-hour to 300 to 330 terawatt-hour, which is very, very low. So to give you some data to compare with, last year, target was way above that but was above at 345 terawatt-hours, and the production during the high of the COVID crisis in 2020 reached 335 terawatt-hours. So EDF basically expects the nuclear availability to be lower than it was during the COVID crisis with all the lockdown. To protect the end consumers from the skyrocketing prices, the French government decided to raise the ARENH volume, so the nuclear volume dedicated to the EDF competitors, by 20 terawatt-hours, from the 100 already in place, only for 2022, of course, and to sell these additional volumes at 46.20 euros per megawatt hour to ensure a fair remuneration according to the French ministry, which is also expecting the measure to cost around 2 billion euros, so a quite significant impact for EDF. But that's not the only measure the government intends to take, because it also wants to increase the French coal power plants maximum operating hours up to 1,000 hours in January and February, whereas currently they are limited to only 700 hours per year of production. And to compensate for this higher production capacity, let's say, not capacity, but operating hours during the critical winter season, their limit should be reduced to 600 hours for the remainder of the year. Now looking at the forward prices, so not much surprise, but a few interesting things to notice. First, of course, the forward prices spiked as well, especially at the end of the year, tracking the skyrocketing gas prices, and of course on raising concerns regarding the nuclear availability coming for the upcoming year. But what is, I think you should notice, is that only the Cal 22 really surged. When you look at the other dotted line, which represents the Cal at the time, Cal 23 and Cal 24, you can see that they were quite spared by the crisis and the really, soaring energy prices. And that's very interesting because it reveals two things. The first one is that the market considers the current energy crisis as temporary and not as a structural change of the market. And the second one, and this is more for the outlook, it means that actually the bearish potential of those deliveries, so basically Cal 23 and 24, are actually limited, because since they rise not as high as the Cal 22 at the time, well, they cannot correct as much in the upcoming months. Another interesting thing, but it's quite obvious, is that the French prices in blue are presenting a strong premium over its neighbors' prices. Well, it's basically because France is much more exposed to the nuclear availability and has a much more temperature-sensitive demand. So it's quite logical, even though for some it seems a bit exaggerated, and I think it is personally. It's quite normal to see a higher premium on the French prices. And now for the outlook too, quick sum up. So one of the main messages is, of course, a strong volatility as well should perdure in the power market, basically coming from the carbon market, and also for the same reason. We actually see some bearish factors potential in the carbon market in the power market, for the upcoming months. But it is mainly coming from the gas market. So Évariste already presented you all what we can expect for the upcoming months. But basically, the main bearish risk come from there. So from decreasing Asian prices, keeping high LNG cargoes toward Europe, and the potential Nord Stream 2 start, although the timing of the start will be crucial for the prices. And of course, the evolution of the weather, not for the short-term demand, but more for the impact on the gas storage, basically how low the gas storage will be at the end of the winter. It will strongly depend on the weather as well. Unfortunately, the bearish potential of power prices is very limited because we have a worsening French nuclear availability. So I already talked to you about it. Basically, we can expect extra nuclear units closure in the upcoming months if EDF finds another similar default in the other units. And that, of course, is always supportive to prices. And as you can see on the price, on the curve, on the blue curve, the market is already expecting a very weak availability in Q4 in France. We have a strong premium. The main factor, and I think this is the most important in terms of recommendation, is that we also expect a very rapid nuclear phase out in Belgium and Germany. Basically, we already lost 4 gigawatts of nuclear capacity in Germany at the end of last year, and we expect to close the last 4 gigawatts remaining at the end of 2022. But also Belgium will start closing its units, with first one closed on October and the second one on February 2023. And I put you a little table summing up the capacity changes. That's just the thermal, not including the renewable one, because it's another thing. But as you can see, we will be 5 gigawatts short at the end of the year, and does not include the closure of the Belgian unit in February 2023. Of course, you can heard about Flamanville 3, but it has already been postponed by 6 months to mid-2023, and honestly, I'm not really optimistic about it. When we look at the history of the power plants construction, it's hard to put a strong bet on the commercial operation start date of the power plants. So I wouldn't count too much on it. We also have overall bullish carbon market, even though we do not expect such an uptrend as we have seen last year. It's still bullish. And of course, we have cold winter risk. Even though today we are seeing those really harsh winter risk decrease, there are still a lot of uncertainties, and there are still a lot of time before the end of the winter. So that could change actually the situation. And basically, my recommendation there is, as you can see on the chart, we are still in backwardation, actually a strong one. But fundamentally, we expect the thermal capacity to be strongly reduced very quickly. So this backwardation is not really consistent with what we expect in the upcoming years. So we could see some opportunity for the longer term contracts. And that's about it for the carbon and power markets. Perhaps I can answer some of the questions, Julien?
Even if we are very late on schedule. First one, regarding a comment you made. Let me publish that. So what do you mean with gas is fully out of stack? Gas plants are not running?
No, it's a good question. No, by that I mean just that gas, in the merit order, gas is fully now behind the coal one, the coal power plants, yeah. So that means it's still marginal. So that means that gas is still running. Some of the gas is still running, at least. But in hour per hour, it will depend on the actual demand. But no, it just means it's behind coal. This is just what I wanted to mean.
Okay. Second question: who is actually selling those coal at 100 euros per ton strike on the UA market? Only speculators or compliance buyers?
It's actually hard to say. I don't have any indication on who are selling this coal, but it's more likely to be, speculators. It's purely financial products So of course, you can have utilities offering such kind of strategies, but with a structurally short market, when you exclude the market surplus, and basically we still expect the market to be bullish, it's hard to bet on the bearish trend currently. So I think it's more, short-term view and short-term strategy from investors.
Okay. So one last question. So when do you expect renewables to change the trend in power prices? As in the question, we see that 70 euros per megawatt hour looks to be the standard for future, compared to historical level around 40 euros per megawatt hour.
Yeah, it's a good question that come often, and actually, when you look at renewables, you always have to take into account the intermittency of the means. Like basically nuclear is for base demand, thermal power plants is really flexible one. So you cannot, exchange closure of thermal power plants, basically nuclear and gas and coal, with renewable. Because when you don't have any wind and any solar, of course you will have prices spiked to very high levels. So it's always hard to say that renewable will be able to replace the thermal capacity. Basically, I don't see it happen before the implementation of hydrogen. When we will be able to store energy, electricity, at a high scope, with a high scope, basically at the market scope, of course, the renewable will be able to change this and to push prices back down. But for now, we will still have a quite huge premium, because we cannot expect, the capacity will be rapidly reduced over the next year, basically tomorrow to the end of 2022 and 2023. It is tomorrow in the market view. So yeah, in the very long term, we could see the impact of renewable, but in the short term, I wouldn't expect it to push prices back down. Yeah.
Okay. Thank you, Etienne. Just stay with us. We will just launch the satisfaction survey. If you could take 30 seconds to fill it, please, that would be great. It's really important for us to have your feedback. Just one question, Etienne, if you are still there. Yeah, Etienne, are you there?
Yeah, I am.
Just one question in the chat. Do you think EDF will increase its output target, its nuclear output targets, during 2022, like they did in 2020?
Yeah, it's a very optimistic. It's very optimistic. Basically, no, I wouldn't. It can occur, but really at the end of the year. Basically, in 2020, they did it because they saw that the reorganization of all the plant maintenance and plant outage were working pretty well, but they increased it only because they had a better than expected year, rather than they were expecting availability to be high at the end of the year. So we have to really. The nuclear situation is quite uncertain so far. We don't know how much units will be impacted by the default fund at Choose and TiVo. So it's really hard to say what will look like the availability, not only at the middle of the year, but at the end, it's really blurry so far. But I would not be too optimistic about it.
Okay, thank you, Etienne, for your answer. We'll close the survey. Thanks for those who took the time to answer. It's time for me to close this webinar session. The next one is planned for April 22. So I hope you enjoyed it, and see you soon on our EnergyScan platform. Goodbye.
Bye-bye, thanks.